You are 31 years old and you are good at your job. 6 a.m. 3 monitors. A Bloomberg terminal that costs your firm $27,000 a year. You cover 14 positions inside a fund sitting at $4.2 billion. Base salary, $120,000. Top quartile for your age at a second-tier shop in Chicago. You did not get here by accident. One belief has carried you. The market pays whoever gets the analysis right. Find the mispricing. Build the position. Wait. That is the whole game, as far as you know. A Tuesday in October. Unknown number. The voice is unhurried, the way people are unhurried when they have never needed to rush. Garrett Whitmore. He runs a private family office, $3.1 billion in assets, 22% stake in one of your 14 names, the same company you finished valuing 3 weeks ago. He wants to meet before Friday's earnings call. You go. If you want to understand how wealth actually moves across generations, not the textbook version, but the wiring underneath, this channel exists for that. Subscribe to receive notifications. Level 1, The Note Taker. West Loop. No name on the building. The elevator needs a key card. Whitmore is mid-50s, silver at the temples, shirt open at the collar. He sets 2 glasses of water on the table without asking, then opens a manila folder. Your last 3 quarterly notes on Arden Industrial. Blue pen. Not highlighted, annotated. Every assumption tested, every multiple pushed back on. Someone has been working through your thinking for months without you knowing. The family bought Arden 11 years ago at $4.12. It trades at $31 today. 600%. You ask the question anyone trained in markets would ask, why haven't they sold? He walks you through the arithmetic without theatrics. Federal capital gains at 20%. Net investment income tax at 3.8%. Illinois at 4.95%. On $280 million in unrealized gains, a clean sale costs $80 million in taxes the moment the trade settles. Gone. Permanent. Then he slides a term sheet across the table. $190 million lending facility, 3.4% annually. The position stays intact. The asset keeps compounding. No sale, no tax event. Cash accessed without anything changing hands. You take the engagement. Compensation moves from $120,000 to $240,000. Paperwork signed in under 10 minutes. You don't fully understand what you've entered. That gap between what you think you know and what is actually operating, that is where the real education starts. Level 2, The Modeler. Year 1 is technical. It is also the most disorienting year of your career, and not in a bad way. What you are rebuilding has nothing to do with allocation in any sense you were trained for. Real estate inside a series of LLCs, each one a separate legal container, isolating liability, optimizing tax treatment at the entity level. Equity held inside a trust engineered to step up cost basis at death, which means decades of embedded gains disappear entirely before heirs ever touch the asset. A stake in a private credit firm where carried interest is taxed at long-term capital gains rates instead of ordinary income. Every asset carries 2 jobs at once: return character and leverage utility. 11. Alone in the office. You run the model. Scenario 1, sell, pay the tax, reinvest at 8% annually. Scenario 2, borrow at 3.4%, hold, let the position compound untouched. 30 years. The gap between the 2 lines is $340 million, with identical return assumptions in both. The only variable is a payment one family refused to make. Compensation moves to $480,000. You stop registering the number. A second family comes into the picture. third generation. A water utility bought in 1987 for $18 million. A sovereign wealth fund arrives with a clean offer, $680 million, 12 times EBITDA, 60-day close. The patriarch doesn't ask about the buyer, doesn't ask about the multiple. One question, what do we borrow against it today? Answer, $290 million at 4.1%. He says that's enough for the next project. Thanks the room and leaves. You walk out thinking differently about a word you've used your entire career. Exit. It no longer means what it did. Level 3, the builder. A tech founder comes in with a problem that has no solution inside anything you were trained on. $1.4 billion in a single equity position. His own company, built over 11 years, he cannot sell not cleanly. The volume alone would move the price against him, and the tax event would trigger simultaneously. He is not trapped by the market. He is trapped by his own success, and the two exits available to him both cost more than he is willing to pay. You build the one that doesn't exist on paper yet. An exchange fund. He contributes his concentrated position into a limited partnership alongside other investors bringing unrelated securities. Gain deferred entirely. No taxable event on entry. Full diversification. No shares hitting the open market. No price impact. 4 months. Legal fees at $2.4 million. When it closes, he calls from somewhere on a boat. He says he feels like he won something. You don't say anything. You understand it differently. He didn't move faster than anyone else. He moved through a door most people don't know is there. This is also when the geometry shifts in your head permanently. A portfolio is not a stack of positions. It is a lattice. Real estate generates rent, but it also backs a credit line at 50% loan to value, which funds the next acquisition, which also serves as collateral. Pull one piece and you don't just lose its return, you stress every node around it. Selling isn't subtraction, it is structural damage. Compensation crosses $950,000. If you've made it to this level, this channel was built for you specifically. One subscribe keeps the structural analysis going. Come back. Level 4, the defender. No press release. No announcement. A publicly traded holding company is being pressured by an activist demanding the sale of its real estate portfolio. And the controlling family brings you in to build the response. The activist's case is clean. Valuation logic, airtight. 3 years ago, you would have written that exact memo yourself, and every number in it would have been correct. The controlling shareholder holds 41% of the equity. 2 generations. Cost basis, negligible. Embedded gain on the real estate, $940 million. A forced sale strips $260 million in taxes immediately and permanently. It also cuts an income stream that has delivered $38 million every year for 19 consecutive years through rate cycles, recessions, contractions. Not a projection, a check. Then there is the third thing, the one that never appears on any spreadsheet the activist filed. Voting control over 3 major office markets for the next 40 years. The ability to shape what gets built, what gets financed, who gets the call. That is not a financial asset. It is a structural one. No multiple captures it. It compounds in access and relationships and the kind of positioning that takes decades to build and one transaction to permanently end. You construct the defense. A recapitalization paired with a leveraged dividend returns capital at a scale that satisfies the activist's liquidity demand without triggering a disposition on the underlying assets. AREIT, restructuring, carves out a vehicle offering the activist a clean exit without forcing a full sale. 6 weeks. 4 law firms. 2 investment banks. The activist accepts. The city blocks stay. The income continues. Compensation reaches $1.9 million. Whitmore calls after closing. He says you understand now. Not a question. He is right. The market wasn't wrong about the valuation. The activist wasn't wrong about the price. But price and control are not the same asset. Only one of them was ever on the table. Level 5, the architect. The deal in front of you now is the largest thing you have touched. It is also the most exposed. Consolidated holding structure across 3 jurisdictions, appraised at $2.8 billion, embedded gain of $1.9 billion built over 22 years. Tax liability ranging from $380 million to $560 million, depending entirely on how each layer is assembled and whether the IRS accepts the characterization of the transfers at each one. You are threading liquidity and tax deferral through the same needle simultaneously. Cross-border jurisdiction layering. Grantor retained annuity trusts. NAV facilities providing liquidity against net asset value without triggering a recognition event. Tax character arbitrage across carried interest, long-term gains, and ordinary income. A securities lending spread program repositioning cost bases across transferred entities without tripping constructive sale treatment. The IRS has been watching this family for 18 months. 3 weeks ago, a structurally similar arrangement at another family office was formally challenged. Outcome still pending. You are building something that may not survive scrutiny. You build it anyway because the cost of inaction is $560 million, and 4 generations of family policy come down to 5 words. We do not sell. Compensation is $1.9 million plus carry. You have not thought about the number in months. Your network is pulled in to fewer than 30 people. Every one of those relationships carries more weight than anything you owned at 31. Outside that circle, most conversations have become a kind of performance, a functional version of yourself running, while the part that actually thinks stays somewhere else. The distance between what you know and what can be said out loud has stopped feeling temporary. It is just the condition now. If this level lands differently than level 1 did, you already know what this channel is. The ceiling is not where you think it is. Subscribe to receive notifications. Level 6, the principal. You are no longer advisory. You co-invest. Equity and carry inside a consolidated vehicle, managing $6.2 billion across 7 family relationships. You sit beside the patriarchs now, not presenting to them, not advising them, but in the outcome with them. Annual compensation, $3.8 million, plus a percentage of realized returns on structures you built from nothing. The working vocabulary is different at this level. Prime brokerage haircut thresholds, NAV lending covenants, margin call waterfall mechanics, repo line management, basis trade execution against concentrated positions, cross-collateralization triggers, collateral rehypothecation limits across 3 custodians, 12 terms most finance professionals recognize, 4 they could not define under pressure. Every credit facility running through your hands, NAV loans, securities-backed lines, pledge facilities against the real estate vehicles, flows from the same source, a structured lending desk at one global private bank. 3 years working with this desk, you know the relationship managers by name. You have never once thought carefully about the institution sitting behind them. Who is on the other side of every facility you have ever closed? What they actually hold. One afternoon, a new $340 million facility on the table. You pull a thread you have never pulled before. Where it takes you is somewhere you were not prepared for. The question is simple. Across 7 families, $6.2 billion in assets, every NAV loan, every pledge line, every securities-backed facility you have ever closed, who is actually sitting on the other side of all of it. One desk. One structured lending platform inside a single global private bank. Not a team, not a division. One centralized credit engine that has been the silent counterparty to every transaction you have built for 3 years, and to thousands of transactions you had nothing to do with. You pull their public filings. The number stops you cold. $1.3 trillion in collateralized lending facilities, extended to over 400 family offices globally. Every borrow, not sell strategy you spent 6 years learning, they funded it. Every patriarch who refused to sell. Every founder who deferred a gain. Every family charter encoding we do not sell across 4 generations, they borrowed the liquidity from this institution, paid the spread, and named it permanence. The desk owns none of it. No toll roads. No city blocks. No water utilities. No equity position in anything. What they hold is simpler than any asset you have ever structured and more durable than all of them. The right to price money itself. Here is what every strategy in this system actually runs on. The borrow not sell trade has one operating condition. The borrowing rate stays below the asset's compounding rate. The spread between 3.4% and 8% is not a feature of the asset. It is a policy outcome. It exists because someone with authority over a different variable decided it should. From 2009 through 2022, the Federal Reserve held the federal funds rate below 1% for most of that period. Leverage across family offices expanded 340% in that window. Assets pledged, repledged, borrowed against, compounded at spreads that felt like physics. Permanent. Structural. Inevitable. March 2022 to July 2023. The rate moves from 0.25% to 5.5% in 16 months. Several families who had held for decades sold. Not a change in philosophy, not a better opportunity. The one variable they did not control moved beneath them. And the architecture they had built their entire strategy on repriced overnight. The structured lending desk adjusted its terms, collected the wider spread. Its positioning didn't change in either direction. The families absorbed the volatility. The desk absorbed the margin. The patriarchs you have sat beside, the men who held through recessions, activist campaigns, and 2 generations of tax code changes, were not the owners of the game. They were its most sophisticated participants. That gap between owner and participant is where 6 years of your education actually lived. You were learning the rules of a game whose table belongs to someone else. The real principle in the borrow not sell strategy is not the family that executes it. It is the institution that prices it. Controlling the cost of money requires no assets at all. Everything in the system arrives eventually as collateral, as margin, as a line item on a facility that reprices on their schedule, not yours. The map you hold is accurate. The structures are real. The returns compounded exactly as modeled. But the territory operates under laws written by someone whose name you have only ever seen in fine print. Tax Council responds in 3 weeks. The consortium's exclusivity expires in 6. The IRS ruling on the challenge structure is still pending. The map is detailed. Every LLC, every trust, every exchange fund, every REIT restructuring, every NAV facility threaded across 3 jurisdictions. You built all of it. You understand all of it. You do not own the toll roads. You do not own the city blocks. You do not set the rate. Another family is waiting. Another position Another embedded gain inside another structure, inside another rate cycle you did not set and cannot move. The game continues one level above where you thought the ceiling was.